entities that buy all these conventional loans and FHA loans are trimming a little bit in terms of what they are buying, what they're not buying, but that opened a whole section of non-QM loans, non-QM, non-qualified mortgage loans that are being purchased. About 30% of all loans in America today are done non-QM. The non-QM type of product is like a bank statement loan, a stated loan, foreign national, TIN numbers. These are the type of loans that people who aren't standard, I say standard, what I mean by that is if you're going to do a conventional 30-year fixed loan and want the best rate, you obviously need the best credit, and you also have to be a W-2 employee. It's just the way it looks to the lenders. The risk profile that you have when you do that is a lot less than people who don't have that, right? So you're going to get the best rate, you're going to get the best product available, and it's going to be bought and sold by Fannie Mae or Freddie Mac. And if you are one of these non-QM type people, we have a couple of people coming on the show today to talk about that. Bill Orr from Malibu Funding and George Gonzalez from Malibu Funding, two of the great loan officers who work here at the company, and both are involved heavily with this non-QM sector. Now, why is that? Because smaller companies, smaller lenders like Malibu Funding, Inc., the company that sponsors the show and who I work for, they're the type of people who can take the time, normally a borrower who has a bank statement program, or they are a, let's say, asset-based only, or they're equity-based only, meaning that you have 25-30% into the property. That's your main qualifying asset or main qualifying feature of the loan product that you're going to get. People who sell to Fannie Mae and Freddie Mac don't normally have the time to be able to go through that with you. Why is that? Because they're your conventional lenders, your big boys, Chase, Bank of America, Wells Fargo. These are the type of banks and people where you walk in and what you're going to get is a loan officer who is a registered loan officer, not a loan officer like you have at Malibu or many other great lenders in the Southland. Certainly in San Bernardino and Riverside counties, and I want to say hi to them and KCAA, KMET, and our friends up in the Tahoe area at KTHO. All of these areas have borrowers who aren't necessarily traditional. And the reason that smaller companies, smaller lenders like Malibu Funding, and as I said, many other great lenders, you go to these type of companies because they can spend time with you to build your particular loan file for submission to lenders that do non-QM products. As I said, the larger companies, the big box banks, do not do that because they do not have the qualification to be able to handle that type of loan. And because the securitization, scrutinization on large institutions like that demand that they have a very simple or simpler approach to where when you walk in, you W-2'd 750 FICO, yes, we can, 20% down on a purchase, yes, we can get you a loan. Those are the type of people that go into those banks, and the reason they do is because the rates are smoking and the service is good, and normally you have your checking account there, you're going to have your loan there, maybe your car notes with them, and maybe your retirement is with their wealth equity funds. And this is the type of service that a large bank can give to you. I know that many of you out there have accounts with these large banks, and they're great institutions if you have that particular profile as a borrower or as an investor or any number of other things that you might have with them. However, if you don't fit into that box, you're going to need somebody to spend time with you so that you can make sure you get the best submission to the lender that can give you the best product and the best rate. And these are smaller places, and anyway, we're going to deal with that with Bill Orr and with George Gonzalez today as they talk about what options you're going to be able to have when you want to go out there and buy a loan. The real estate market currently in San Bernardino and Riverside is an ascending market, although not as it was in the previous year. And what I mean by that, ascending means prices going up, right? So if prices are going to go up 2, 3, 5% this year, in that range, let's say, I want to say it's more towards 3 to 4%. That is a little bit less than it has been going up the past 3 to 5 years. And as you know, anybody out there who has a loan who was waiting until that day where that loan was no longer underwater, well, you passed that watershed moment probably 2 years ago, maybe 2.5, 3 years ago. We're in 2019. We're getting closer and closer to summer, right? I mean, kids getting out of school, moves being made, people wanting to buy a new home or maybe scale down their particular home into something else. And that's the third guest on the show is someone who wants to talk a little bit about what happens when you're, my age, right? I'm 64. So for most people in the country, in their mid to late 60s, you start thinking about retirement, right? You've been working a particular job for your entire career, or maybe this is your second or third career, and you're feeling like slowing down and wanting to take it easy. Your Social Security is going to kick in. I believe mine is going to kick in at 67. Darryl, yours? About the same age, you think?
67 and a half.
67 and a half. Okay. Now, for those of you who are now just getting to be 60, it's going to be 70 sooner or later for you people. And I think that goes to 70. Do you know what year that does?
Pretty darn quick.
Yeah, quickly, right. And I assume, and I don't know why I assume this, but I imagine that younger people, let's say you're 30 and under, if you're thinking about your retirement benefits.
I wouldn't rely on that.
Right, I wouldn't rely on that at all. And so part of what you need to do is begin to focus on retirement. Now, I know it's silly, right? You're 30 years old, you're 35 years old. Maybe it's the first time listening to the show and you're thinking, oh boy, the old person station. Well, this is true. This is what older Americans who are retiring think about. The one thing that we can assure you is that you're going to be this age one day too, if you get lucky, right?
I think it was Richard Pryor said you don't get old being stupid.
and excellent. And for those of you who don't know who Richard Pryor is, YouTube it. He is one of the brilliant ones back in the day. Anyway, he's quick story. I didn't know Richard Pryor, but I did see a set of his live one. I used to work at a comedy club in New York City called Catch a Rising Star. This is way back in the 80s, right? Probably before a lot of people listening to the show were born. Anyway, he came into the club, a very bright, energetic person, and somebody who obviously had a clear idea of what he was doing. Now, the rest of the comedy club scene, the circuit, the comedians who watched him were just in awe and in love with the guy, right? But for a lot of us, we were scratching our heads as to why is this significant and why is this funny? Because one, he was on the edge of what was to become the comedy scene for the next 30 years, and he sort of introduced a whole different type of style of comedy. And anyway, that's who Richard Pryor was. So, getting back to what we were talking about in terms of your retirement, my retirement, when you have to be able to start planning for that, and what do you have to do to start planning for that? Main element here to think about is that Nina Penny, who's coming on the show, will talk a little bit about how you go from a large-scale home to a smaller home, and what you do with the money you make on that home, especially nowadays since you probably got equity in your home. A lot of older Americans have their homes paid off. So if you use that money to buy locally or move to a different state, you can actually purchase using a reverse mortgage. And I say that because sometimes the equity within the property that you just sold, you need to keep cash. So buying a reverse mortgage allows you to do so with 50% down. You can keep a large portion of your down payment based on the amount of money that you made selling your house. You sell your house for $400,000 in California, you go to Nevada and you got to pay $250,000. Well, in order to get a reverse, you got to have 50% in, so that's only $125,000, i.e., you made $400,000 on your property in California, so you're keeping $325,000, $375,000 of the equity that you made rather than spending it on a new house or acquiring a mortgage. And as you all know, a reverse mortgage has no mortgage. You don't have to make payments. You can, but you don't have to. There's a lot of great guests, a lot of great information on the show today about the guests that we have coming on. Thanks for listening to the show, and we'll be right back. I'm Jeff Barton, your host for the Las Vegas to Listen to Me. I did the Las Vegas Real Estate Show earlier in the week, and now I've got that on my mind. Anyway, this is The Mortgage Voice, and I'm Jeff Barton. We'll be right back.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice for the mortgage industry. 888-713-2929 is our telephone number. If you pick up the phone or write down the phone number, call us with a question that you have. There are many questions when you go to buy a house. Okay, scenario. I'm in Las Vegas during the week, and we shoot the Las Vegas Real Estate Show, and you can also see that on YouTube. This radio show plus that show are on YouTube. There's probably 150 plus shows there, and you can get caught up on what's happening or just watch a bunch of shows and see the trends that go on week to week based on what we give you as information on the show. The YouTube, if you go to my channel, it is Jeff Barton, the Real Estate Voice, and that's my YouTube channel, as I said, if you want to catch what's happening here. But so I'm in Las Vegas shooting the show last week, and a deal came up, right? And this is a scenario by which everybody dreams about, right? I have a friend who runs an office of real estate for the realty firm out there in Las Vegas, and he is a wholesaler in properties in Las Vegas, Nevada. Now, what is a wholesaler? Okay, so if you're in the market to buy properties and you're thinking flipping, think flipping without fixing up, which means that the margins are thinner, but you don't do anything except buy from some person and sell them to another person who's going to do the fix-up and try to do the retail end. That's called wholesaling. Well, he's been doing it probably for 20 years out there, and he's very good at it. And he approached me. I actually help him out on some of the fix-up money that he does for some of his projects. Malibu Funding does lending in all of these kind of scenarios, and that's a little plug for them. But so he approached me and he said, look, I have this property and I want to wholesale it, i.e., I don't want to do any of the work. I just want to flip it to somebody else. And that means assigning the contract. Any real estate contract you get out there, you will see that you have either an ability to assign or an inability to assign that particular purchase contract to another buyer. A lot of residential real estate contracts prevent you from doing that. However, in the wholesale world, you write your own contracts. You don't go with a particular, like in California, they have CAR forms, California Association of Realtor Firms, which most realtors use. Non-associated realtors use their own contracts, and this particular person in Las Vegas does that. There was a one-bedroom condo right off the strip on the other side of the 15. That'd be the west side of the 15, kind of between Tropicana and Flamingo. If you know the area, you'll know exactly what I'm talking about. It's behind one of the casinos. I forget which one it is. It's near the Orleans Casino. That's where it is. So if you know Vegas, you know where that is. It's a tremendous location. The guy's selling it to him for $65,000. Now think about this: one-bedroom condo, $65,000. The HOA is $220,000, and if you were going to get a mortgage on the thing with all in, HOA included, it costs you about $750 a month. Now you're thinking, wow, this is a deal. Yes, it is a deal. So he said to me, I will flip it to you on a wholesale basis, and I'll give it to you for $85,000. And I said, okay. So I looked it up. The property's worth about $110,000, $115,000. That's what Zillow was saying it's worth. So if you give or take whatever, so if you went in there and fixed it up, you could make $10,000, $15,000, $20,000, which is kind of the margin out in Vegas for flipping anyway, unless you get one of these smoking deals that you want to do yourself, which my friend didn't, and he wholesaled it to me. So I'm thinking, great, this is terrific. So he sent me an assignment contract, and we're going through the contract, and I called him today, and he said, yeah, there's some issues with the title, because in any deal that you get, especially on a wholesale level, at this end of the cycle, which is at the north end, the far end of the 10-year cycle between busts and booms, right? We've been in a boom since 2010, and now it's 2019, so we're at that north end of the 10-year cycle. So he said, yeah, here's what happened. Back in 2008, this particular property had gone into foreclosure by the HOA Association. As you all know, the homeowners associations in a lot of HOAs went after deadbeat people for not paying their dues, and they foreclosed on them. In Vegas, in Florida, in a number of other states, it was big, and it really affected value. And when people say, hey, that's a non-warrantable condo, this is one of the reasons, because there's litigation outstanding against one of the homeowners, or there's not enough HOA capital in reserves. All of these things are what makes a condo lend-worthy or not lend-worthy. Anyway, you can get around that with non-warrantable condo loans and things like that. So this particular condominium, the homeowners association had not been paid. A lien was placed against it, and the homeowners association foreclosed on the property. Prior to doing that foreclosure, a quitclaim deed was sold from one person to another person, and there was no title search done, so the new buyer inherited the lien on the property, right? This is going back maybe 2-3 years ago when this happened. So this new buyer now has to, and the condominium association has to go through a whole new process of foreclosing on the property because the original owner doesn't own the property anymore. And laws being what they are, you have to go through whatever this process is. And however, the forestalling of this particular HOA foreclosure went on. So 2-3 years go down the line. Now, the guy who bought it put a tenant in there, right? So the tenant was paying a monthly based on a yearly lease. Now, anybody out there who knows the law will tell you you cannot foreclose on a tenant if they have a valid lease. Well, that's essentially how the forestall happened on the foreclosure by the HOA. The HOA forced the owner to give him a month-to-month lease after this particular lease. So it means that 30-day notice the guy's out, which means that the HOA can now foreclose. Once they do, they get 30 days notice, and the tenant gets out. So my friend, this owner who has to get out because he's going to get foreclosed upon because he's at the end of this cycle in his lease is now 30-day month to month, he decides to try to sell it to my friend and get $65,000, right? Without paying the HOA fees. So we're going through the process of seeing if, one, the HOA will waive that. Two, if they won't waive that, what will it take? Because then that, for us, would come off the purchase price. Because obviously the seller is just trying to make a quick $65,000 and get out the door. He has no plans on paying any of the HOA stuff. So this is an in-process type of deal. If you get into a situation where something looks unbelievably good, almost too good to be true, either you are very good at what you do and you've been at it a long time, or you are looking a gift horse in the mouth. So make sure that you pay attention to the simple rules of real estate, right? Clear title and making sure that you have the money and the property will carry if you're planning to hold it, or that there's equity in the property if you're planning to flip it and sell it. These are some of the workings of what we do in the business. I really wanted to share that with you. Also, I was out there, and I want to bring Daryl in just for a second. So I stay downtown, right? Downtown Las Vegas.
Wow, downtown has really changed.
Yeah, really changed. And it's a lot like Disneyland. There's a whole thing on Fremont Street, and it's covered, and, you know, there's the Four Queens are down there. Yeah, it's a lot going on down there. So I went to this place across from my hotel. It was a bar, right? Now, I've told the audience 100 times, if not once, I don't drink.
Yeah.
But I wanted to see this bar because it had just such a, you know, an interesting and eclectic look of people going in there. So I approached them. Now, when I walk around, most times when I'm in business attire, I have casual pants on, but I have a tie and a nice shirt, which is how I'm dressed for the radio show and how I'm dressed normally for business. So I walked up, and staring at me is a guy who says, okay, fine, here, we got to put this wristband on you. Obviously, wristband, because you can drink, and they didn't card me for obvious reasons. If you're watching on TV, you know exactly why.
I think you said 64 at the beginning of the last segment.
Exactly right. So quickly, I know I have a minute left. So another guy comes over and he says, hey, you have to take your tie off. I go, what? He goes, yeah, you have to take your tie off to come on. I'm like, come on, what are you kidding? He goes, no, that's part. And he showed me the back of his shirt. I guess he was the bouncer there. Now, this guy had a tattooed head and about 50 gauge, and anybody who knows what gauges are, those things you put in your ears to continue to widen the lobe, right? So that you look more and more like a pirate. He had 50 gauge pirate earrings on, and he had a tattooed head. And he's looking at me saying, "You can't come in here dressed like that." I said, "You got to be kidding me. Look at," I wanted to say, "Look at yourself." He said, "No, we want people to come in, relax, and enjoy themselves." I said, "Well, it's not for me today." Anyway, that's a quick story about Vegas. I'm Jeff Barton, your host for the Mortgage Voice, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, our telephone number. Pick up the phone and give us a call, give us a ring, and we can help you make some decisions. You know, it's the springtime. If you're looking for a purchase loan, if you're looking for a refinance, if you're looking to try to sell a property, if you're trying to figure out what's the best advantage you can take of equity in your home right now, and what are some of the advantages of working with a broker like Malibu Funding, our next guest is a loan officer that works for them, is because they can take the time and go through it with you. You go to one of these big box banks, ain't going to happen. They haven't got the time, the energy, and they've got to churn and burn in order to keep the doors open. So if you're thinking about doing something that is a little bit off, a little bit different, a little bit outside the box of a normal retail bank, Malibu Funding is the place. And the guy up next is a guy that's going to describe three of those programs. Bill Orr from Malibu Funding. Bill, how are you?
I'm doing great, Jeff. How are you doing today?
You know, I'm okay. The Bruins are still alive, which I'm very happy about. Come on, are you kidding?
I know, right?
I mean, I saw that Game 7 last night, too. It was exciting. I mean,
I know.
There's nothing like playoff hockey. Anybody out there who's not a hockey fan, sorry about that, but I just said it. I know.
Best game in the world and the fastest game in the world, that's for sure.
It's the fastest game, and if you go live, you'll never, ever doubt what we're saying, because it is one of the most spectacular events to go to live. It's just, the crowd is so into it. The emotions of the almost goal, of the terrific save, is just great. It
is great, and yet for a newcomer, you can't really get a true appreciation of it on TV. But
nope.
If you live up near Ontario, California, you've got the Ontario Reign.
Right.
We've got minor league hockey. We've got professional NHL hockey in Southern California, all over California. So go see a National Hockey League game if you can.
Yes, exactly. We'll send this clip right over to NHL Network to make sure we get on air tonight. Hey,
give us free tickets.
Listen, we're in spring buying season. It's an unusual market. We've seen the expanse of some programs that we just didn't see 3, 4, 5 years ago. Give us a little bit of a rundown of how we might be able to help that type of borrower.
Absolutely. What I want to focus on today, Jeff, is this whole new, or it's been around for a while, but the new home buyers, may be new, called alternative income. And here's what we mean by that. You know, a lot of people know that you can buy a home with only 3% down payment using Fannie Mae or FHA, or in some cases using a Cal HFA program. You can even get a house with no down payment. Mm-hmm. The problem is, for some people, is you have to be able to fully document your income. And some people, particularly people who are self-employed. So if you are self-employed, and if you're listening to this radio show, this conversation is for you. Because a lot of people who are self-employed, they can't or choose not to disclose all of their income. Let's use an example of some kind of a vendor that might, or a store owner that might be a cash business.
Right.
Well, you know, it's not my job to be the IRS, but, you know, I think it's safe to assume that maybe a shop culver doesn't really declare all of his cash income, but they still make good money. But if that money is deposited in his bank, we can actually use bank statements to prove their income.
Right.
So if we have a person who works for, I don't know, pick a store, and they maybe they're a manager of a pool company, and he collects his salary with paycheck stubs and W-2s, that's easy for a loan officer to document and prove his income.
Right.
But for a self-employed person who doesn't claim all their income, or maybe they have all this income but they take too many write-offs,
Right.
Well, that person deserves to own a home too. That's where these bank statement programs are absolutely perfect.
Okay. 24, 12, different types of programs, rates based on how many bank statements you give them? How does that work?
That's right. So what Jeff was referring to when Jeff says 12 or 24, he's really talking about how many bank statements do you have to provide. So for a consumer standpoint, a term I want you to become familiar with is called risk-based pricing. And that's how mortgage companies or mortgage investors price their mortgage loans. So the higher the risk, the higher the rate. So if you can provide 12 months worth of bank statements, we can help you get a loan with only 10% down.
Wow, that's good.
It's great. If you can provide 2 years or 24 months worth of bank statements, we can probably get you a slightly better rate. And here's how that works. If you are an employee and you receive a W-2 and a paycheck stub, that's one way of calculating income.
Right.
On this type of alternative income, what we do is we go through your bank statements, all 12 months of them with 24 months of them, and we add up all the deposits. Not transfers, but actual deposits into that account, your business funds, your checks you receive from vendors, your credit card deposits, your cash. Had a client recently who owned a liquor store, and a lot of deposits were cash and credit cards. So we added all that up, divide that by 12, or divide that by 24, and that's your monthly income, and that's how we calculate it.
Okay, so this sounds like a program where it enables many, many more people, especially business owners, people who, in the past 5 or 6 years, we've probably seen a couple million new businesses open up in California. Yeah. The economy is better. There's more disposable income for people to go out and spend it. And for those new business owners who are now, as you say, depositing through their businesses, either credit cards or cash or however they take in their payments on whatever their business is, they too have an ability now to be able to go out and buy a home.
That's right. And even some of the, there's a huge movement across all industries in the country, the work from home thing.
Yep.
So if you've got somebody who works from home and they may not have a storefront, they may not have inventory, but they receive their income however they receive it. So, and some of the places aren't even that big. If you have an independent, maybe like a salesperson or something like that, they don't even have inventory or anything like that. So they have their money deposited into their personal bank accounts. Now, it's a business.
Right.
It's their whatever job they have. But they have their money deposited into their personal bank accounts because they're a small one-man operation.
Right. Hey,
all we have to do is have that client provide us 12 months or 24 months worth of bank statements. We add everything up, and that's how we calculate their income. And then after that, the loan program is pretty straightforward. We can get them a 30-year fixed. We can get them a loan that might be adjustable for the first 7 years.
Right. Everything
else is the same. They still have to have decent credit. We get the property appraised. But the great thing is you do not need a paycheck nor a W-2 to get this type of loan, and we don't need tax returns for that matter either. We just go off their bank statement deposits.
Let me talk one other loan program with you. We have a couple of minutes left. The CPA Stated Income Loan Program that you mentioned to me. Explain a little bit about what that is.
Okay, and this is another type of loan that goes onto alternative income. So if we've got somebody who makes a fair amount of money, but they can't disclose their income, if their CPA will be cooperative, and a lot of times I can help with that. So that's where it'd be beneficial for, like you mentioned at the opening of the show, these big box banks won't do this for you.
Right.
But if I can come in and I can work with the CPA, I can work with the client who wants to buy a house, and depending on how the letter from the CPA is written, lenders will accept that as their income.
Right.
Now, you do have to have a slightly larger down payment. You will need a 20% down payment for that if you have decent credit. But that is a huge step forward than where it was before. We kind of didn't have any options for those people except really high interest rates and really high points and all those kind of things.
Right, and I think what you're saying, and I said in the first segment of the show, about 30% of the loans now are done in a non-QM form, i.e. they're not sold to any government or quasi-government entities, Fannie or Freddie or Ginnie. And this large segment and growing of the marketplace enables a lot more people to get in to buy a house. And it's not necessarily risk if you have more down payment, correct?
That's exactly correct. There's not as much risk, and you hit it exactly because of all the people who are self-employed now, small businesses, things of that nature.
Right.
There's need for these people because the people have good credit, they make good money, but they can't document their income for whatever reason. We can now help those people.
Hey, Bill, shout out your phone number, if you would, for people who are listening who obviously need to use you or the programs that you're talking about so they can get a hold of you.
Great. So my name is Bill. And my last name is Orr, O-R-R, and my phone number is 818-406-4744. I'll repeat that. It's 818-406-4744.
Bill, thank you very much for coming on the show once again, enlightening both me and the listeners as to the terrific job you do and also the products you offer. Thanks a lot.
Thanks so much, Jeff.
Anytime. I'm Jeff Barton. I'm your voice for the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice for the mortgage industry. 888-713-2929, our telephone number here. Give us a call so we can help you decide, help you make some decisions about whether you want to buy, whether you want to sell, maybe you want to refinance. There's all kinds of reasons you need to talk to us here on the show. We'll provide you with information. Now, I don't care whether you use me, you don't use me. The great company that I work for and sponsors the show, Malibu Funding, Inc., we're going to help get you answers. And that's why we bring a number of different types of guests on the show each and every week. We've been doing this for about 5 years. KCAA, KMET, K-Tahoe, and a number of other outlets. We're on YouTube. We have a Twitter account at Jeff6493. Any way that we can get in touch with you to help you so that you can make better informed decisions. It's the biggest decision you're going to make financially in your lifetime. So make sure that you have someone that you can trust and someone that you get the right information from. One of the people on this show who works for Malibu Funding has come and graciously assented to coming in today to talk to us again from Rancho Cucamonga, George Gonzalez. George, how are you?
I'm doing great, Jeff. How about yourself?
You know, I'm okay. Thank you very much. I mean, we're in a very, I guess it's an exciting market. Real estate prices have calmed down a little bit, and rates went down a little bit. They haven't really shot up. We sort of are in a holding pattern on those two things, but it allows some, I guess, new people to get into the market.
Yeah, that's correct. You know, right now, you know, with the FHA raising their limits just recently,
right,
loan limits, and you know, these first-time buyers only need 3.5% down, and you know, it's turned into a buyer's market. You know, now it seems like that there's a lot of houses in the inventory out there waiting for people to come get them.
Hey, interesting. A year ago, it was just the opposite, right? We were looking at seller's market, and if we have more inventory on the market, obviously allows more buyers to be able to choose, and that's always a good thing, especially if there's a win-win for both buyer and seller. Tell me a little bit about some of the loan programs. You mentioned FHA. What are some of the other ones that are popular right now?
Right now, the popular for the purchase, you know, depending on credit, obviously. Of
course.
If they're in a higher credit score, let's say, for example, 700 and plus, they have loan programs out there with 5% down where there's either borrower-paid mortgage insurance that you pay or lender-paid mortgage insurance, which they put it in the interest rate, and your payment's a bit higher, but you don't have to pay MIP.
Right.
The good news is, you know, it's tax deductible, the higher rate, the whole interest off of the rate versus the MIP that people are paying now is not tax deductible any longer. So,
I see.
You know, they have an advantage to, if they want to put down, like the minimum FHA is 3.5%, minimum for a good loan for conventional would be 5%. So if they had that little extra 1.5%, it'll benefit them in the long run.
Okay, tell us a little bit about Rancho Cucamonga. What's going on locally in your area that you're trying to do? I know you do some charity work. I know that you help out locally. You got your own family. Tell us about what's happening in your area.
Oh, Rancho, man, is lovely out here. There's a lot of activity going on. They're still messing with the price. The median price out here for a house is probably about $500,000.
Right.
And,
right.
So if you're going to buy out here, you're going to have to put like 20% down or close to it, to stay in the conforming range. But, other than that, there's a lot of activity, got a lot of partners out here trying to just, we try to go to events. We try to, make Malibu funding known at different events, charity events, like you mentioned, for schools and, community centers and stuff like that. And kind of helps out, helps let people know that we care. We're not just trying to come up there and take business. We're here trying to do our duties.
Well, what is the charity that you're doing for the school? The one coming up. Describe what that is, and I believe you've done it in years past too.
Yeah. So basically, it's for the school. It's a elementary school. A good friend of mine, his wife. As a matter of fact, I'm doing their refinance right now, and his wife, she's a teacher. And so she asked me one day, she says, hey, we're having a little festival for the fundraiser for the school. Would you like to join us? It's basically called a multicultural festival.
Okay.
And basically what they're doing is they're going to have different food from different vendors. They're going to have different companies there who support, the school and the kids and just stuff like that. Just, to get together, to get different cultures together, different cultures.
Of course. And I think, all of Southern California fits into that particular under that umbrella, right, where you have so many different groups that are either together at school or at the church or at different sporting events that are from all over the world, really, and anything that can help do that in this way. And obviously, you're helping the teacher, you're helping the school. I mean, this is the type of thing whereby, that's what local is about. That's what small is about. That's what trying to invest or reinvest back into the community is about, and I appreciate you doing that.
Right.
So let me ask you a little bit about the real estate market, too. You'd mentioned the median price about $500,000. Are there any deals out there? I had mentioned earlier in the show that there was a flip deal out in Las Vegas that I was all excited about, but the problem is that there was a lien against title, and we don't know if we can clear it, so it's probably a dead deal. Tell me about what's a good deal out there that you see that you might be able to do some financing on.
Well, the deals out here, are hard to come by. As you know, most people know somebody at this house, but I mean, you might be able to find something here that I've very rarely seen some foreclosures. People that are having hard times or their house, they just never updated. They bought it in 1985 or whatever and just never had money to update it, so it's just falling apart. And so they're letting it go a little looser. So like in this area, you can probably find, if you get lucky, something for like maybe $385, $390, put in maybe $50,000, $60,000 to get it up to par.
Right.
And then looking about probably $525, $530. So the return is not as lovely as you would want it, but it's still a return. If you have money just sitting there, obviously.
Well, you've got an ascending market, right? Prices are still going up somewhat. What do you think the prices are going up there? 3 to 5% in that range?
Yeah, that's about right. It seems like it's around 3 to 5%. Yeah, that seems about right. Recently, and and like you mentioned earlier, with the rates staying low and the pricing still pretty aggressive in the consumer's favor,
right?
It's helping for business.
Now, you mentioned also you were doing a refi for your friends at the charity. Refis are big in your business, I'm sure, and one of the reasons is taking somebody from an FHA loan and putting them into a conventional loan to save them that mortgage insurance premium. Tell us a little bit about that.
Okay. Well, here's actually, I'm glad you brought that up, because here's one of my biggest loans right now is happening is the programs these guys are liking are people who have purchased an FHA mortgage, let's say in the last, 2016-ish,
Right.
before 2017. So they've gained a little bit of equity, but not quite 20%.
Right.
So what we're doing is, but actually, you know what? A lot of them, the ones that I'm doing right now, have got 20%. So they're at 80%. However, they wanted to do a cash out.
I see.
And if we stay at FHA and a cash out, they're still going to have mortgage insurance, but they allow them to go up to 85%. So they could pull out 5% cash to pay off whatever they want,
Right.
but they're still going to have MIP. So I was trying to figure a solution out. I'm searching these banks, and finally I found this wonderful bank called TCF. I'm not sure if you're familiar with them.
Yeah. Yeah.
They do standalone 10% seconds. So basically, I'm telling these people, get out of your FHA, get rid of that MIP payment to 80% rate and term on the first to get rid of MIP, and then go ahead and get that 10% equity line immediately after you close, and that payment is going to be similar to the MIP payment you just got rid of. However, you now have equity, home equity line to use the money whatever you want. So you're not just throwing the MIP in the air. You have another payment for the second, yeah, of course, but you got rid of the MIP, so it offsets it, and now you have an equity line of 50, 60,000, whatever the 10% might be of your value.
Well, that's a pretty intelligent way to go about it, and it sounds like it could be an incredibly popular program. George, shout out your phone number. We got about 20 seconds.
My number is 909, area code 900-9565.
This is George Gonzalez from Malibu Funding. George, thanks for coming on the show once again. Really enjoy it.
Thank you, Jeff.
Anytime. Thank you. I'm Jeff Barton, your host. What am I? I'm the voice, the real estate voice, the mortgage voice. I'm a voice. Anyway, we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. If you pick up the phone and give us a call, we can help you. And I know that you're thinking about doing a loan, and I know you're nervous about it. You're sitting at home and you're trying to figure out, should I go with this program? Should I go with that rate? Should I talk to this particular advisor? You need options, and the only way to do that is to be able to talk to people in the profession who want to help you. If you go to some people, all they are looking at is you as a dollar sign. Try to come over here. Try to talk to the people at Malibu Funding, and I'll give them a plug. They're a great company. They help me sponsor this show each and every week, and some of the people that work for them are just the best in the industry. They'll take time. They'll work with you. One of the products I talked about earlier in the show is a reverse mortgage product. There's all kinds of ways that is a terrific option for people, but you need somebody who really knows what they're doing. One of the people, she's been on the show before, Nina Penny, joining us now. Hi, Nina. How are you?
I'm doing great, Jeff. Thanks for having me back.
And thank you very much. Nina is a certified. Why don't you give your initials, because I've forgotten them at the moment, but it's one of 150 in the country that they've given out. So
that's right. It's a certified reverse mortgage professional. We call it ourselves a CRMP, a crimp.
A CRMP. Well, the reason that it's important is because there's a lot of people who say they can do it because that just happens to be a slow time in the business, so they figured they can, do reverse now. But you need someone dedicated who's really spent their career helping people, older Americans, to try to wend their way through the, the financial needs of retirement and older age, right?
Mm-hmm. Absolutely.
Give us some examples of how that might work in the retirement years for some people. Let's take this for an example, and I used this a bit earlier. I'm selling my house in California, and I want to move to an area that perhaps the prices aren't as high. Let's pick either Nevada or Arizona. How would a reverse mortgage purchase be able to help a particular borrower like that?
So let's say you sell your home there in California, and you net at the end of it, let's say $500,000.
Okay.
And you move to Arizona, and you're looking at homes, and you find a beautiful home that you love, and let's say it costs, $400,000.
Okay.
And instead of taking on more debt by getting a 30-year loan, you check out an option of a reverse mortgage. On a reverse mortgage, it would require that you bring in about 50% of the sale price.
Right.
And then you're not obligated to make any remaining payments as long as you live in the home, as long as it's a primary home. You have to pay taxes and insurance, but you're not obligated to make a mortgage payment until you sell the home or until you pass.
And the equity, not the equity, but the money you save in not having to put down 20% and then taking on debt, by the house sale you had in California, you still have all that money in the bank, right?
Absolutely.
Right.
And, everyone will say that when you retire, you don't want to take on more debt because you're not earning income anymore. You can only look at how to eliminate debt.
Right.
So this really does complement that philosophy.
I think the reverse mortgage product. Now, for those of you who would like to see or hear from Nina more, she was on our Las Vegas real estate show for the last couple of weeks. And if you go to YouTube and look up Nina on our YouTube channel, if you just type in Jeff Barton, the real estate voice, I will come up, the show will come up, and then you can search for Nina. But she talks about this and a number of other things concerning reverse mortgages. One of the things that I think is important to understand is there's a lot of misconceptions about what goes on or what had gone on in the business. Can you dispel some of those for us?
Sure. I'll cover the big ones.
Right. Okay, good.
The main thing is that people feel as if you take out a reverse mortgage, you're signing your home over to the bank, and that's not the case. You remain on title. It is your home. You can sell it whenever you want. Any built-up equity in the home is yours. So that's definitely a misconception.
Right.
Another misconception is that when you pass, if you owe more than the home is worth on your reverse mortgage, let's say you live a nice long time, and the market downturns and you end up owing more. You never owe more than the appraised value of the home. So let's say market downturns, you owe $300,000 on your reverse mortgage, but the home value is only $100,000. The reverse mortgage insurance covers the gap.
So therefore, if you did end up selling, which you probably would, you would basically not owe more than whatever the appraised value was, 95%, is that what you said?
Absolutely, yes, it is 95%.
So that's a great protection, right? That tells somebody that, okay, you're not borrowing on time, or you're not saying, hey, this is some sort of leverage or, some outside-the-box stock market play. No, this is saying that if your house doesn't cover it, don't worry about it because you're covered by the insurance you've been paying.
Absolutely.
Yeah, that's very good. Some of the other particular misconceptions in the marketplace about reverse mortgages are that, oh my gosh, my spouse died and they're going to kick me out of the house.
No, you know what? The last person on title stays in the house is fine, no problem. It's when the last person on title leaves the home. So, if you're married and one spouse passes, the other one can stay in the home as long as they live or they sell it.
Right, and the important thing you said is they have to be on title, right? So if you're listening out there and you're considering a reverse mortgage or you have a reverse mortgage, make sure that both spouses are on title, right?
Absolutely. With reverse mortgages, let's say one spouse is 63 and the other spouse is only 61, but wants a reverse mortgage, they can still move forward with it. We will calculate the numbers for the reverse mortgage on the younger spouse as a protection to make sure that they are covered as well.
I see. Now, the counseling that is done for the reverse mortgages, it is independent and it is, explain a little bit about that because I don't think many people understand it.
So the counseling is after you meet with a loan officer and they explain kind of the process to the numbers with you. A safeguard that's put in place by HUD is you have to attend the counseling. The counseling is not whether the borrower really understands everything so well as it is that the loan officer explains to them about the product.
I see.
So it's a touch-up on the loan officer's work, not on the borrower's side.
I see. So essentially this is a protection for the borrower?
Yes.
By checking to make sure that the loan officer did what they said they did, right? Or making sure that, the disclosures are understood and that they're done correctly.
Right, and that the borrower, the loan officer explained how the loan works.
Right.
And the fundamentals, and not that, they go into this loan thinking they never need to pay taxes or insurance because, you have to do that. That's your obligation. So it's really just a safeguard that you understand as a borrower that there's going to be interest accruing, that you have to keep up with taxes, insurance, and HOA.
Right. Working with older people is different than working with someone who's a lot younger. There's a lot more distrust because of the way that this is all they have, their house,
Right.
And so working with them. How do you enjoy that? How do you like helping people that need that kind of financial guidance?
I personally, I love it.
Mm-hmm.
I have great relationships with my clients. I love being able to provide clients with an option to help them grow wealth tapped up in their home, to show them how the product can be used in several different ways, and, changing lives. Because in some aspect, when we retire, you're always looking for how to gain more income.
I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening to the show each and every week, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.